Let's get right into it. Today, we're unpacking the incredibly dramatic and honestly kind of contradictory headlines surrounding the Brampton housing market in 2026. If you've been tracking this, you know things are shifting at lightning speed. We're hearing everything from a total market collapse to an unbelievable buyer's renaissance. So we're going to cut right through the noise today and look exactly at what the raw data is telling us about this massive paradigm shift.
All right, let's kick things off with a pretty stark observation from a recent market analysis. A report from Property Daily highlighted the sheer panic happening on the ground as landlords watch their supposedly recession-proof rental gold mines just completely evaporate. They literally stated, "We are watching the collapse of the investor-driven market in real time." Now, that is a wildly aggressive claim, but as we're about to uncover, it's rooted in a very real, very swift economic shift.
Which naturally begs the question, how on earth did the GTA's absolute hottest real estate market cool down so incredibly fast? To figure that out, we have to peel back the layers of all those dramatic YouTube narratives and just look straight at the facts. Because it wasn't just some random change in consumer vibes, it was this perfect storm of policy, economics, and shifting demographics that totally rewrote the rules.
Section 1. The rental market collapse, from gold mine to ghost town.
The tremors really started in the purpose-built and secondary rental markets, and it sent absolute shockwaves through the whole region. Now, the crucial thing to understand here is that this single number, 7.1%, represents the massive crash in one-bedroom rental rates in just one single month, back in December 2024. And this wasn't just some seasonal blip. It triggered a sustained downward spiral straight through 2025 and into 2026. Over-leveraged investors were suddenly pulling in hundreds of dollars less per month than they'd planned for, completely breaking their cash flow. And this brilliantly illustrates exactly why that tenant pool evaporated so rapidly. A federal mandate completely slashed international student permits by 49%, dropping the nationwide total from 305,000 down to just 155,000. When you combine that with the fact that students and newcomers were basically the engine of the Brampton rental market, this policy shift totally broke the business model for speculative investors. The maths just didn't work anymore.
Section 2. Brampton by the numbers, a market in transition.
So what happens when a rental market breaks? Well, it bleeds straight into housing inventory. As investors completely scrambled to offload their underperforming properties, total listings surged over 14,000 in 2025, 14,683 to be exact. That is almost a 20% jump in inventory year over year. Suddenly, the market was just flooded, creating this massive glut of supply that hesitant buyers just were not rushing in to absorb. Because of that flood, the average days on market ballooned to 55 days. And if you were trying to sell, say, a luxury property over $2 million, it could take even longer. This essentially killed that whole fear of missing out, that FOMO frenzy that defined the market just a couple of years ago. Sellers went from fielding multiple blind offers in hours to waiting nearly 2 months just for a solid, realistic bite. When you look at the Q1 economic indicators, the drop across almost all economic sectors is just undeniable. Total construction value nosedived from $622 million in Q1 2025 to just $360 million in Q1 2026. Housing permits fell from over 1,100 units to just 772. The market basically slammed the brakes hard on new development amid all this widespread uncertainty. Section 3. The policy ripple effect, federal and provincial impacts. Beyond just those student caps, a convergence of major government policies fundamentally altered who can actually buy and how properties are managed within Brampton. First off, the foreign buyer ban was extended to 2027, effectively cutting off the overseas capital that historically fueled pre-construction sales. Second, the Bank of Canada policy rate holding steady at 2.25% kept borrowing costs elevated enough to really deter casual flippers. And finally, the citywide residential rental licensing program rolled out, adding strict oversight and compliance costs to local landlords. Collectively, these objective policy shifts squeezed out the speculators and totally reshaped the homeownership landscape. But underneath that massive investor exodus, there's actually a remarkably solid foundation. Demographic data from WAHI proves that Brampton's core remains incredibly stable. A staggering 76% of households function as single families. So, while the noisy investor-driven segment is going through a really painful correction, the vast majority of the city is anchored by people actually living, working, and raising their families in their homes.
Section 4. The construction bottleneck, growth versus infrastructure. Despite those stabilizing demographics, accommodating the future growth of those families is proving to be a huge headache. Brampton is facing a structural hurdle in actually building the 113,000 new homes mandated by 2031. Here's how this infrastructure crisis really unfolded. It started when Bill 23 introduced aggressive provincial housing targets. Traditionally, the region relied heavily on high development charges, or DCs, paid by builders to fund the infrastructure for these new homes. But to try and spur building, the region slashed those DCs by 50%. The unintended consequence, without those funds, the region of Peel had to pause hundreds of millions of dollars in water and wastewater projects. You literally can't build houses without water and sewer lines, which ground new builds to a sudden screeching halt. Just to put that into perspective, regional development charges can add a whopping $154,000 to the cost of a single detached house. Developers passionately argue that this massive fee suppresses building and ends up punishing buyers. But on the flip side, as the region cuts these fees to incentivize the developers, the municipalities suddenly lack the capital to build the utilities those very homes require. It's an incredibly complex catch-22, and it remains completely unresolved.
Section 5. The 2026 Buyer's Market. Opportunity in the Shift.
Now, for anyone aiming to actually live or invest long-term in the Peel region, this stabilization is honestly fantastic news. Let's talk numbers for a second. According to Pinnacle Realty and TD Economics, the overall average price has settled at $885,938. Detached homes are holding their prestige, hovering just over $1 million, $1,023,135 to be precise, while semi-detached homes provide a much more accessible entry point around $808,000. So while Ontario prices might fluctuate a bit further before a projected rebound in 2027, these current entry points offer incredible long-term value when you compare them to those frantic, over-leveraged pandemic peaks.
What you should really take away from all this is that value in Brampton is shifting away from pure blind speculation towards fundamental urban growth. We're witnessing the rise of true transit-oriented development, specifically anchored by major projects like the Ontario LRT. Neighborhoods with stellar connectivity like Mount Pleasant, Heart Lake, and Bramalea are absolutely thriving. Plus, there's a growing innovation district attracting real professional tech talent. This is a profound shift from a speculative bedroom community to mature metropolitan living.
Rather than just an endless suburban sprawl of subdivisions, Brampton is undergoing a massive physical transformation. It's evolving into a highly sophisticated economic engine poised for sustainable, long-term growth. When you actually strip away the panic of those over-leveraged, short-term investors, what you're left with is a maturing city that's finally building real, tangible infrastructure.
As we wrap up this explainer, I want to leave you with a final thought to chew on. As infrastructure slowly catches up to ambition in the GTA, is this balanced, highly regulated market the actual new normal for suburban real estate, or is this just a long winter before the next unprecedented boom? Think about how these layers of policy and infrastructure are fundamentally changing the way we value homes. Thanks so much for hanging out with me to explore this. Keep learning, and I'll catch you in the next explainer.